Okay, this problem is an example problem to make adjustments for changing tax rates. As we can see here, the problem says Herb Inc. analyzed its temporary differences as of December 31st, 2011. The enacted tax rate was 35% for 2011 and all future tax years. The total amount of taxable temporary differences as of the end of 2011 was $540,000. All of the temporary differences relate to non-current items. So we're going to assume that in early 2012 the taxing authority changed the rates for 2012 and beyond to 30%, and we're going to prepare the 2012 journal entry to record the tax rate decrease. Then we're going to do the same thing and assume that instead of being decreased, the tax rate was increased to 40% in early 2012, and prepare that journal entry to just see the two differences and how to account for changes to the deferred tax liability account. So, if we do this, we assume that in 2012 the rates changed to 30% from 35%. You're going to have, you can make up a little table like this. So, before the tax rate increase, we have 540,000 of temporary differences. We times that by the tax rate that was 35%, and that's 189,000. The tax rate was decreased to 30% right here, and so you have 540,000 times 30%, and that lowers it to 162,000. So to make that journal entry, you have this right here. You have a debit to deferred tax liability, non-current, of 27,000. So we refer to that table that we just were at, and you have $27,000 is the difference between the deferred tax liability account before and after the tax rate decrease, and it's just 189,000 minus 162,000. That's 27,000. Then you have a credit to income tax benefit as a rate change, and it's the same amount obviously. Then if we go to number 2 here, assume that instead of being decreased, the tax rate increased to 40%. So to make that change, we just have the same type of setup, and you would show the deferred tax liability account for non-current items. Before the tax rate increase is 189,000. Then after the increase, you take the 540 and you times that by 40, and that increases the account to 216,000. So the difference between those two is 27,000 as well. So to make that journal entry, this time okay, so up here, when the account decreased, you debited deferred tax liability. Okay, and now you're going to debit. You're just going to reverse these two. You're going to debit income tax expense this time because it went up for 27,000. And if you refer to the table we were just at, this is to reflect the change in the deferred tax liability account before and after the tax rate increase. So you have 216,000 minus 189,000. That leaves you with 27,000. So you debit income tax expense and you credit deferred tax liability, and that is how you do that problem.